Perfect. Okay, and you can all see that okay?
Yep, we can see it.
Perfect. Okay. I appreciate you guys having me on. I knew you guys were growing, but I didn't know you guys were this size. It's really impressive. Looks like I got 31 people on the call.
That's about a quarter of the team.
No kidding. Wow. That's perfect though, because that's enough that if someone else gets a multifamily deal, they just ask someone on the team and usually my name pops up. So that's perfect. Okay, so I'm gonna run through, probably take up about 25, maybe 30 minutes of your time. This is the kind of presentation where I do a pretty good deep dive. So if you guys have been on a presentation where I'm with one of the single family lenders, usually I give a very short version of this presentation, maybe 5 or 10 minutes, just to kind of give you a flavor of it. But this one I kind of go a deep dive and I show underwriting and how CMHC looks at these deals and specific documents that I need. So if anybody has any questions as I go through, feel free to just ask them on the spot. No, you don't need to wait until the end. I'm really bad at looking at that chat screen, so if you just want to speak up, that'd be great. Okay, so start off, for those who aren't familiar with this program, I look after everything insured multifamily in Western Canada. So I go as far east as Manitoba, as far west as Vancouver Island. And I'm doing everything that CMHC, but pretty much everything CMHC insures in the multifamily side. So what exactly that is, that starts off at 5 units. So if you're at 2 to 4 unit building, my single family partners can look at that. As soon as it hits that 5th building, they're going to start, sorry, 5th unit, they're going to start sending those emails my way. So the far and away, the #1 most common deal we look at is just your standard apartment building. Pretty basic, pretty straightforward, but that eats up probably about, honestly, maybe close to 90% of our deal flow. But we can also look at mixed use properties. So with these, CMHC wants to limit their exposure in the commercial side. So they want to see less than 30% of the total income and 30% of the total square footage coming from that commercial component. And it still needs to have that minimum 5 residential units for mixed use. Those two alone probably make up about, I'd say, close to 95% of our deal flow. We can also look at affordable housing where the rents are controlled, and CMHC has a new program you might have heard of where they can do up to 95% of a purchase or refinance. I have a specific slide for that, so I will go over it. Students' residences, you can look at those. Seniors housing, seniors homes, and single room occupancy where you have shared kitchen and bathroom facility. So I'd like to do a quick compare and contrast as to what an apartment building deal looks like with and without this insurance piece. When I was a commercial account manager with the Bank of Montreal, I didn't have access to CMHC for multifamily. So when I was looking at it, there'd be no insurance component and it would be underwritten probably 20, maybe 25-year amortization. The rate right now would probably be closer to 5%. And your max loan to value would be 75% loan to value. So with CMHC, I can extend out the amortization to a maximum of 40 years. And the rates coming right down, we're probably closer, bond rates have come up since I've adjusted this presentation. So we're probably about 2.9% for 5 years. And I'm doing all of my debt servicing based on contract rate, contract amortization. And those two differences really help bring the leverage way up. And I can actually go above 75% loan to value to 85% LTV. So I'm helping people purchase apartment buildings with only 15% down with this program. And they do pay the premium on that, but the savings at the rate, you recover your premium expense within the 5 years. So how we process these guys. So I don't have any adjudication software on my side. I don't have Filogix or Velocity or whatever you guys are using on the single family side these days. So you're dealing just with me from start to finish. So when you first come across the deal, then send you an email asking me, how you even start the deal. And I'm going to run through the debt servicing with you. And I'm going to be there right up until the end when I'm dealing with the lawyers for successful close. I do have an underwriting team, analyst team, funding team, but usually you're dealing just with me from start to finish. On the rare occasion, I might have an underwriter reach out to you directly if I'm worried about something getting lost in translation, but I'm pretty much a quarterback from start to finish from these deals. So when you first come across one of these guys, I'm going to ask you for 3 things: the rent roll, the operating statement for the property, and I'm going to ask for a personal net worth form. So the biggest difference between what I do and what the single family guys do is I'm only looking at the cash flow from the property. So I'm only looking at the income that those renters are paying. So that really helps keep the presentation time down because it makes things a lot simpler. So I'm looking at the rent, I'm deducting the income, I'm reverse engineering, and I'll go through this in detail, how much the building qualifies for. So we're over the phone, I'm going to talk to you about leverage, rate, fees, reporting, requirements, documentation. We're going to talk about timeline. We're going to talk about your commission. You're going to take that back to your borrower, and if they're happy at that point, you're going to issue what's called a letter of interest. That letter of interest has the broker's name and address right at the top, and then it basically outlines, it's a 2-page document on our letterhead that basically outlines everything we discussed. If the borrower's happy at that point, we get them to sign off on that, and they submit a $5,000 good faith deposit, then we start the underwriting for CMHC. That probably takes us about a week and a half to get the CMHC application in. And then we just wait for them to come back to us with the certificate of insurance. This presentation was probably, came out, I would say last time I met this presentation was probably in the fall when they were at 8 to 10 weeks. Now they're probably closer to 4 or 5 weeks from submission to issuing that certificate of insurance. And that's actually quite reasonable. This summer, you might hear about them being slow because this summer they were pushing 12 weeks on a couple deals, but 4 weeks now is really quite reasonable. So I got a couple of questions here. Can it be done in a holding company? I got a slide on that. Yes, it can be done in a holding company. That's totally fine. I know on the single family side, that's a bit of an issue, but yeah, holding company, totally fine.
I'm going to turn up my volume.
BC leases are signed for 1 year, then move to month. What do we do about this whenever you can? That's fine. Yeah, if they're on a month, that's totally fine. If it's the only issue we run into is when the tenants are there for less than 6 months. So if it's less than 6 months, then you're kind of looking at an Airbnb situation, short-term housing, and CMHC stays out of that game altogether. That's more geared towards tourism than long-term housing. But sorry, back to the slide. Once we get the certificate of insurance back, then we pretty much have everything. We're ready to go. We issue the commitment letter. Borrower signs off on that. We send it to the lawyer for funding. That process, it did get up to about 4 months in the summertime, but now we're probably closer to 2.5 from start to finish. I just kind of quickly want to go through the document requirements. Some of these are pretty straightforward, but I want to highlight a few. So purchase agreement, obvious. Mortgage statement for refinance, also obvious. 3 years operating statement. This can come in a number of forms. Notice to read or financials from the accountant. They can have a QuickBooks, that's fine, or tax statements, that totally works as well. Current rent roll and lease agreements. So the current rent roll, that's going to give us the most accurate gross revenue for the property. If there's a couple of vacancies, we can usually work with that. If there's, if half the building's vacant, that's going to be tricky. But if there's a couple of vacancies, usually the process is long enough that we can get those filled up. So we can go with 100% occupancy. Property tax statement, insurance, and utility bills. Those are the only expenses that CMHC takes from the property we're financing. There are other expenses they use for debt servicing, but those are very simple formulas, which I'll show you at the end of this presentation.
What's the approximate cost of the appraisal?
About $2,500. Yeah, we can get away. That's for like a commercial appraiser doing a job. We have been able to get away with some residential appraisers for 5 and 6 plex apartment buildings. The only thing we ask for that is that they do a proper income approach valuation. Some of these, because they're cheaper, they kind of cut at corners a few times. We've run into some issues where they'll give us an appraisal with just a comparison approach, which is typical in the single family space. But when we have an income producing property, we really need to see that income approach valuation. So then you can go a little bit cheaper, but like if you're looking at one that's probably 20 units, usually single family guys are going to stay out of that space. So about 2,500. And that's the same for ESA, that's the environmental site assessment. That's about $2,500 as well. So environmental report, that's going to kind of give you the history of the subject and the history of the neighborhood and which way the neighbor slopes. So if you have a gas station next door, but the property is sloping away, then the likelihood for contamination is going to be pretty low. So for environmental report, they gave us a break for 5 and 6 plexes. We just asked them to fill out an environmental questionnaire. And for an appraisal, we need one up to 24 units, 25 and above, they waive that requirement. So finally, for equity takeouts, we have this form we get them to fill out, because for any funds, any new funds, when they're taken out of an existing property, they need to be to buy, build, or improve other multifamily dwellings to as small as a duplex. So before 2 years ago, we could just do equity takeouts all day long and not ask questions where the funds were going. But CMHC, they're a government entity, and they're really trying to encourage housing. So they cracked down on that 2 years ago. So as long as it's for one of those 3 uses, buy, build, or improve other multifamily, we're fine doing it. If it's for, boat purchases, vacation, cryptocurrency, then CMHC is going to have an issue with that. It's everything to do with the property. I got a question here. Are market rent letters able to be used for vacancies? No, we can't do that. If it's like a 20-unit apartment building and one's vacant and it's in an area with low vacancy or reasonably low vacancy, we could argue for that. But typically CMHC wants to see actual rents. They're not going to use market rents. So a lot of times you'll see, yeah, that was what I was going to get to, Amber. What if it's a new build? Then there's no income at all. So what we have to do in those cases, we have a bridge product we can close with. So we'll close with the bridge, 75% loan to value. It's 5% per year with a 1% fee. So we'll close with that. It's closed for 3 years, closed for 3 months rather. And then so that's the exposure period. So allow them to lease up the property. And then 3 months in a day, or if they need longer, 6 months to lease up the property, we can get all the CMHC approvals we need for the long-term takeout. That's what we have to do with those guys. Okay, so for the individuals purchasing, I need a net worth form, 2 years T1s and notice of assessments. A little bit of a background on the borrower really helps, just what they do for a living, why they picked this particular property. We have an application form, just a 2-page application. We have to confirm some assets. So CMHC wants to see 25% net worth. So if it's $1 million deal, they want to see 250,000 in real estate assets or liquid assets. And finally, I have a spreadsheet from CMHC that I need filled out for all the other real estate assets. It's really kind of a 1-pager that I get the broker to do. It's pretty standard form. Can we get the Coles notes of this presentation? Yeah, I can share this one around. This presentation is really only 5 slides, so I can share this one. It's not a problem. Someone was asking about a holding company. That's absolutely fine. We just ask for articles of incorporation and 2 years financials if it's existing. But the vast majority of these, they're going to put it in a holding company, just haven't incorporated yet. So I'll underwrite it as, Smith Holdco to be incorporated. And then the lawyer will incorporate maybe a month before closing. We'll let CMHC know the exact name of the borrower, and then we're good to close. So either way, it's fine. A couple notes. Yeah, again, for the 3rd time, holding companies are totally fine. I usually leave that up to the borrower and their relationship with their accountant. Typically for the smaller properties, the income is lower. So accountants say, either or is fine. For the larger properties, they typically put it in holding companies, but it's up to the borrower. It doesn't make a difference to us. I've had borrowers put in their personal name or tell me they're going to put it in their personal name. We underwrite the whole thing, and then the last minute they want to put it in a holding company, and that was fine. We're able to make the adjustments, no problem. I always like highlighting with brokers that there's no maximum door limitation in this space. So why I like highlighting that is because there's a lot of borrowers we run into. I was a broker for 5 years, and you come across these borrowers that have 10 properties, and no one's going to touch the 11th or the 12th because they have maximum door restrictions. So I always encourage those borrowers to start looking into the multifamily space. So if they want to look at a 5-plex or a 10-unit apartment building, those guys easily qualify in my world. CMHC likes them because they hit that 25% net worth requirement really easily. And my credit group likes them because it shows that they have experience with renters. If you have a borrower that has no experience with renters, sometimes CMHC requires that we put in a property management company, which typically makes sense. We have a minimum deal size of 500,000. CMHC, I was really highlighting that in the summertime when they were taking their time, but right now 4 weeks is not bad. But I like highlighting this because when a deal comes in, usually the first thing that I'm doing is looking at the subject removal and the closing dates. just to manage expectations, last thing we want to do is change the date at the last minute. So try to manage the expectations up front. Location does matter for us. So major centers fine, bedroom communities are fine. One thing that our investors really try to avoid is small and remote. So think maybe below 20,000 and nowhere near a larger center. Those ones tend to be kind of tricky for us. Broker commission, we can kind of do it one of three ways. We can do a fee split. It's typically what we lean towards in a smaller deal, charge 1%, split that with the broker. When you start getting into deals, maybe $1 million and up, what we can do is build it into the interest rate. So if right now rate is, let's say 2.9, we would charge the borrower 3.1, and that would work out to about a 1% fee, 1% commission paid to the broker immediately after closing. Some brokers just prefer to charge the borrower directly, and that's fine. We typically have that conversation up front, how we're gonna do the compensation. 2 million question here, a $2 million deal would need a minimum 500,000 net worth. That's correct.
Yeah, just answering Prince's question there.
Oh, that was the answer. Yeah. So that people always ask, a follow-up is usually, does the down payment, can that be included in the net worth? And it can. The only thing I know from experience is our credit is going to want to make sure that the building is in really good shape if that's the case. If all their net worth is going into the building and the building looks like it's in rough shape and it's going to need some repairs in the near future, then it's going to beg the question where those funds are going to come from. So, but if it's the building's in like really good shape, well maintained, and he's putting all his net worth in, that's something we can definitely look at.
But for net worth, can't we also use, like, if they have a primary residence? I thought for that one, we showed the property tax statement and their mortgage, and we use that as their equity on their other house, right? You can use that.
Yeah, just send in the mortgage statement, and then CMHC is going to just take the BCSS value. And RSPs are fine too. They're pretty good with this requirement. What is the minimum square footage? There's no minimum. Okay. This is a new program I wanted to highlight. It looks a little bit complicated, and I wrote an article about this for our newsletter recently. And I try to make it simple. It actually is a fairly simple program, but the flexibility of it does make it look more complicated than it needs to be. So I'll try to break it down. If you look at the top table, the dark gray, you can see that's kind of broken down into what I call 3 buckets. And it's what CMHC is really trying to target here. So the first one is affordability. We're trying to target that for obvious reasons. The next one is energy efficiency / kind of climate control initiatives. And the third one there is accessibility. So they designed this program to help builders and buyers try to encourage them to go towards one of these buckets. So, and what you as a borrower are looking at when you're looking at these buckets is you're trying to achieve the 100 points, as they say. Certain achievements mean certain points, and you try to get that 100-point mark. If you don't get that 100-point mark, there's still benefits. So start with affordability. So what they want to see is less than 30% of the median income for a particular market. Like, keep it simple. If it's 100,000 is the median income in a certain market, take 30% of that, 30,000, divide that by 12, you'll get the threshold. As long as the rent for that building is below that threshold, you'll qualify for this program. And the borrower only needs to commit to 10 years. So let's say he commits 80% of his units to stay below that threshold for 10 years, he'll get that 100 points. He or she will get that 100 points. Then if you go down to the table below, you can see what that translates to. So 100 points, it means a 1% premium, which it's normally in my space, normally around 4.5%, 5%. You get a max loan to value of 95%. Your debt service coverage falls to 1.1, and for most buildings it's 1.3, so it's quite strong. And you get up to a maximum of 50-year amortization. It's a pretty strong program. If the borrower only commits to having 40% of his units below that 30% threshold, he'll still benefit. So they'll get a reduction in premium from about 5% to 2.25, and he benefits from that lower debt service coverage ratio. So he doesn't have to commit the entire building. So that's for the affordability. Energy efficiency, we just need a report from an energy professional, and they haven't released exactly who that's going to be or which professionals that is. Those are. They have to release a report saying there's a reduction below the National Building Code standards for the typical building. And then how far below those standards it falls will mean how many points are allocated. Accessibility, this one's kind of interesting. These buildings that are being built with people with mobility issues in mind. So think no steps, doorknobs that don't require a ton of grasping or torquing. So people with issues with their wrists. It's really kind of an interesting program. And there's certifications that they can obtain if they reach a certain level of accessibility. And again, if the borrower commits to keeping so many units at this standard level of accessibility, they'll earn certain points. So for you guys, I'd probably focus more on the affordability one. Any building can become quote unquote affordable if the borrower is willing to commit to 10 years. The efficiency and the accessibility one, that's usually going to be a significant upgrade cost. So that's probably going to be more geared towards the developers. So you might come across the affordability one. More details are going to roll out for that program this month, and the formal launch, they'll start accepting applications on the 7th, and I probably have about 4 waiting to go in. So that's the end of the slideshow. I just wanted to, got a couple questions here. This worked for 3 adjoining properties under separate title. Each property has 2 units, so 6 units total. Adjoining, yeah, this will work for that. Yeah, I do a lot of 3 townhouses with legal suites, and those qualify. That's not a problem. Median rents, increase, decrease with market rents. Increase median as median income. So we're looking at the median income. So if it's Saskatoon, I'll go into CMHC's portal, look up what the median income is for Saskatoon. I think it was about 46,000. I take 30% of 46,000, divide that by 12, and that would be the threshold. So it's the median income. And let me pull up. So here's the. Can you guys see this one?
We just see your thank you CMLS.
Oh, okay. Sorry. I have to stop sharing for a second. Share a new screen. So this one is just kind of to highlight, actually I'll kind of focus a little bit. So this is the debt service calculation I do for when I go into kind of more depth. So I'm going to break this one down. So this, I was looking at a deal last year at Edmonton. There's a 6-unit apartment building. It grossed $10,000 per month, which is so 120 per year. There's no parking or laundry income. And typically for Edmonton, we're doing 5% vacancy. It's a little bit higher than that, but CMHC has allowed us to get away with 5%. And then the yellow expenses here, those are the actual ones for the property. So the property tax in this one was $13,000. The insurance confirmed from the insurance policy was $9,500, and the utilities borne by the landlord as opposed to the tenants was $1,300. So the green ones here, these are just a straight equation provided by CMHC every year. So for repairs and maintenance expense, we're using $750 per unit. For appliance reserve, for any appliances that need to be replaced throughout the year, just $100 per unit. Payroll, this one is actually for Edmonton is $450. For miscellaneous expenses, they use 1% of the effective gross income. Management 4%. Effective gross income, just income after vacancy. So that's everything I have to do to start the debt servicing. So now I know the net income. So when I start looking at affordability, can we get a copy of the spreadsheet? Yeah, I'll show that. I'll share this with you, no problem. So the good thing about this, the way they do it, it's much more simplified than you see on the conventional side. So if you're with a borrower and they want to know what a building qualifies for, you can just call me up. You can tell me what the gross rents are, the number of units, those three expenses, and I can come up with a pretty good estimate of loan to value. And I'll show you exactly how down here. So let's say we're at about 2.9% right now. The building was a little bit older, but it was well maintained. So I was able to get away with 35-year amortization, so 420 months. And down here, you'll see the debt service coverage. So for a 6-unit apartment building, I can go as low as 1.1. So I'm just going to juggle this principal amount until I get to 1.1. Yeah. So we've got 1.5 million. 1.59. And one area where I always hesitate to include this in the presentation is the last part here. So if you're not familiar with cap rates, this will probably be a little bit confusing, but the easiest way to simplify, to explain a cap rate is just the net income from a property divided by the market value. And it comes up with that percentage. If you do search online, you're most likely going to see people use that as a rate of return, but I'm not using it that way in this example. Just a simple ratio between income and market value to come up with that number. And that number I'll find through reports from CB Richard Ellis or Colliers until we get the final report. Then the appraiser does a lot of work to determine this. Oh, it was on the exam. Okay, that's good. That's really good. But it is, if you don't deal with it all the time, it can be a little bit confusing. Anyways, so for this property, the cap rate for multifamily in this neighborhood was 5%. Right. So what CMHC does here is they take the net income, divide it by the cap rate for the area, 5%, to come up with this market value here, 1.534. And so I can only lend up to 85% of that value. So even though a debt service is at 1.5, I can only get up to 85% of 1.5, which works out to 1.33 million. So you see it falls at 85% loan to value. Debt service is a little bit stronger. So at this point, I would call the broker and say, I can't quite get to 1.5, I can do 1.3. Does the borrower have the resources to make up that shortfall? Edmonton is a pretty good market. This was really an outlier. Usually the actual cap rate and the market cap rate are really close. And if they're off, usually CMHC gives us a little bit of a break with these, but I just kind of wanted to quickly go through. But I'll share this with you guys. If you don't want to do this, when you come across a deal, just fire it to me. A lot of my day, I work on these, so it's not a problem. Or if you want to learn and you want to do one and send it to me and I can go through it with you, that's totally fine.
Steve, Blair just funded one with you a little while ago. I was just going to get Blair to talk about what her experience was and what came up that she wasn't anticipating. And I think
the hardest clients ever, Steve.
It was a combination of that, and you did run into some tough luck with that one.
Yeah, there was a little bit going on with that file, but it did fund. It was in Edmonton. I didn't know what I was doing, truthfully. And like I can say, you guys, Steve answered my phone. I think I called him 100 times a day. Like, I'm not even lying. I think Steve cringed by the time that I was phoning him. So the one thing I thought that kind of was a little bit was the rate where we had to the set rate, Steve, where you have to, we've got like 10 minutes to get this rate and the document signed, and you literally have to have everybody on board docu-signing within the span of like 10 minutes or something. So that was the only weird thing, if you wanted to talk about that. But that was, I think everything else was, just kind of little normal file hiccups along the way.
For sure. Yeah, no, that comes up all the time, that question. So we're not a traditional lender. You would also call them a balance sheet lender. So meaning that when time comes to lock in the rate, they have the funds available. Like they have those funds on deposit. Like we're not a balance sheet lender. We're an origination and servicing company. So we work with the institutional investors to fund we find the deals and fund their money. So what happens is when we have the deal all ready to go, we need the security in place. So it needs to have gone through the lawyers. And that's when we have to formally lock in the rate. Like just the nature of who we are, we can't formally lock that in at an earlier date. Like it just, investors won't do that. So we have to kind of wait till we're about to close, formally lock it in, and then we can close. We'll guarantee that spread 100%, but the bond rate will fluctuate up until closing time. So how it works is we'll request a rate from the bond desk. They'll send it to us. And there's just so many parties, that's what makes it kind of ugly. So the bond desk sends it to me. In this case, I sent it to Blair. And then Blair sends it to her borrower. And then in that case, we just needed kind of an email approval. So then works its way back to me, and then we can formally lock in the rate. And then later that day, we can get a document signed. So we didn't really need the document signed within 15 minutes, but you're right. It's like you feel like you're launching a missile and it has to be done within 15 minutes. So we kind of have to have that all lined up. It is a little bit stressful, I agree with you. But there were two other issues that came up with your appraisal that your deal that I almost never see. We have to get on our appraisals or our transmittal letters. We need CMLS on there, CMHC, and computer share trust companies. So they facilitate our mortgage. And I think it's only ever happened this one time. Usually we'll ask for it and it's fine. But this guy, I talked to him, I got the sense that he had been bullied a number of times into putting multiple lenders on an appraisal. So his back was up against the wall. So he was on guard as soon as we asked him. So when I told him, no, it was only one lender. It's the insurer and the facilitator. After talking to him for about 20 minutes, he let his guard down and he gave us the report we needed. So that was kind of a bit of a pain. And the other pain of that deal was that guy, he had run into some child support issues years earlier. I think when he was in his early 20s, run into some issues, couldn't make his payment, and his wife registered a PPSA registration against him. It puts a floating charge over every single asset he owns. So in a default situation, she can go in and sell literally anything she wants. So that had been resolved at least 15 years earlier, but that PPSA registration was still there. So we had to get rid of that before we could fund. So that was probably the last minute stressor of that deal.
I feel like I'm getting PTSD. Like when I tell you guys, I talked to Steve like 1,000 times over the span of 4 months. I think I actually talked to Steve like, but I think my situation was a little bit wonky, but I mean, would I say I wouldn't do another one? No, I totally would, as long as I had Steve at my back. Like they're not as hard as I think we think they are. So like I want to give it a go again.
Yeah. No, that in hindsight, yeah, it was a quirky in a few areas, but that was a really good deal for us. We've only been in this space for probably about just over 3 years now. So we're really aggressively trying to get deals done and kind of grow some market share. So we have no problem walking new brokers across the finish line. So if someone comes across a deal and they don't know, rather than, if you want to pass it on to another, a commercial guy to get that done for you, he'll probably give you like a 65-35 split. You could do that, no problem. Or I can help you walk through the whole process. And if you want me talking with the borrower, dealing with the borrower, that's not a problem. I always take my marching orders from the broker. Some want to be involved the whole way, fine. Some want me to deal with the broker when things get kind of squirrely at times, and that's fine as well. So
the one thing I would recommend is if you're doing like, I didn't increase my fees on this one, so I didn't get paid a whole lot. So I would say really go through the whole deal, kind of know what you're doing, and then decide what you're doing for your fees. Like if you wanted to increase, I think you have the option, if I remember correctly, Steve, you can increase the rate by 0.25, or you can add on a lender fee, increase the lender fee, right? You can do either.
Yeah. So we'll do a fee split or build it into the rate.
Yeah, like I think it's just something that I would recommend you looking at, because I didn't do it and I wish I would have.
Mm-hmm. Yeah, and when I was a broker, I was doing residential and commercial. And in commercial space, it's you just charge the borrower. It's just what you do. It's how you operate. A lot of brokers aren't comfortable doing that, so we can work with that up front. Just let's talk about how much you want to make and how we're going to work it in. So you have some
Steve?
flexibility in these.
Would you look at something like an apartment style building that offers different levels of assisted living? Like I wouldn't call it a senior's home, but there's an option for meal plans and that kind of thing.
Yeah, so that's more of it might fall under the seniors umbrella. If that's the case, they have all the units have to be single occupancy. They could take a look at that, but I know when deals like this get kind of middle ground with CMHC, they'll say, send it in and we'll review it, and more often than not, they approve it. They're quite good with these middle ground type deals. There's so many deals that just don't fit perfectly in their box, and they understand that. So as long as it kind of meets long-term housing needs, they're pretty good with it.
Does anyone have any other questions for Steve? Amber's just
share-
under. Go ahead, Steve.
Oh, sorry. Can you remind me what the CMHC fee is? Yeah, no problem. So the fee itself, that's $150 per door. So when we send the package into CMHC, they're going to say, okay, we've received it. Now we need our fee, and we'll have the borrower send that directly to CMHC. The premium is a sliding scale. So if they go max loan to value, max amortization, it would cap out at 5.25. And that's obviously amortized and built into their payment.
Yeah, there's a myth. They always say, commercial deal, you need a 35% down payment. So like you said, with 85% loan to value, so most, because I'm in Ontario, Toronto, right? So
Yeah.
I'm a real estate broker last 18 years. I do very less commercial, but mostly I'm a residence. But I come across mostly, the client, they need a BDM, BDS, the other people always they talk about, they say you need a 20, 25, 30% minimum,
Yeah.
any commercial deal.
Mhm.
So like you mentioning, you only need a 15% loan to value. So this is really amazing,
Yeah, if you go into the conventional commercial space, those borrowers, that's their option. Those borrowers that have built up their portfolio, their residential portfolio, and they have 10 residential units, their options are to go into more commercial space, so talking industrial, office, retail, and yeah, those will max out at 65% loan to value.
Those ones, right?
Yeah, that's right. Yeah, the only way you're going to get up to 75% of the commercial space is if you own a business and that business is operating out of that property. Otherwise, you're capped at 65. So it is very, very attractive for people that are kind of stuck, quote unquote, on the residential side and want to continue building their portfolio.
So what kind of down payment you need if you're looking at medical zoning, let's say 2,000 square foot unit?
So this is a straight commercial deal.
Yeah.
Yeah, 65%.
Okay, thank you.
Yeah. We're pretty traditional with our conventional appetite.
So would a program like this work if you were buying like a 5 or 6 bedroom house and then renting out the rooms and sharing the kitchen?
Sharing the kitchen? No, because the way CMHC looks at that would fall under a single room occupancy. The way they look at that is a kitchen is a unit.
Okay.
Yeah.
So you had mentioned the shared kitchen. Is that sort of like, can you explain that then? What do you mean by that?
Yeah, so if one kitchen is one unit, it doesn't really matter how many rooms share that kitchen, as long as you have 5 kitchens.
Oh, okay.
So if you have 100 rooms with 5 kitchens, that would be a 5-unit building.
Got it. Okay. Perfect. Thank you.
But I'll share this with it was Jody, the debt servicing, and I've got reports on cap rates, and I've got CMHC's benchmark expenses for those green expenses I showed you. I can share that as well. But any questions pop up, just feel free to fire me an email. We can get on a call or I can answer your question, not a problem.
Steve, thank you very much. It was so informative. I think I want to buy one of these. I just don't know if I would qualify. Now, I just wanted to mention to the team, you guys, tomorrow, our speaker is Merchant Growth. We had them on, I don't know, I think 4 months ago, 5 months ago, it was Jason Roy's one good thing he's ever brought to the team. But for those of you that missed that presentation, I had put something on our team Facebook page. This merchant growth that we're having tomorrow has some really cool products. I had a client of mine phone in saying, hey, Tara, I want to buy out my business partner and I want to pay him out, I don't know, 250,000. We think our company's worth whatever, 500,000. Normally I would have said, well, I can't do that. Go to your bank. It was a heating company. So really there was nothing for the bank to secure. But I said, well, try this merchant growth, because we had just had them on. And without even doing anything, I had a commission check, I think of $4,000, and all I did was send an email. So I strongly encourage you to pop on the Zoom tomorrow. I think, you know, it's just another tool in your tool belt if a client calls you. But yeah, that's all. That's a wrap. Thanks again, Steve. And I will see whoever can join tomorrow. Oh, Karen used them too. Karen, I'll get you to talk tomorrow about how things went on your file. Thanks, guys. Enjoy the rest of your day.
Thank you. Bye.
Yeah, see you guys.